Carl, thanks for joining us.
Good to be with you.
We've seen a number of countries trying to push their exchange rates down this year. What's going on?
Many countries across the globe are struggling to keep up their pace of export. Their feeling is that by lowering the value of their currency, their products will be more inexpensive for foreign buyers. In addition, there are a lot of countries for whom deflation or disinflation has been a problem. Part of that is when your currency is strong, imported products are cheaper. So by devaluing the currency, they want to address both their export and their inflation challenges.
If we look at the euro has been fairly strong, even though the economy's been relatively weak. What's your take on that, and what can the European Central Bank do about that?
That has been a puzzle for quite a while. Even though the European economy is growing at about a quarter the rate that it is here in the United States, the euro has continued to appreciate against the American dollar. One reason for that, we think, is that capital is flowing into Europe, where yields on some of the sovereign debt, the same sovereigns that were at risk of default just a few years ago, are attractive to investors. In order to make those investments, people have to buy euros, and as a result, the euro has been strong.
For those countries trying to devalue their currency, there are risks associated with that, are there not?
Absolutely. For countries that are reliant on foreign flows to buy their national debt, if investors in the country see the value of their currency depreciate, they might be less inclined to help support debt and deficits there. So countries need to be aware that they're introducing some losses on foreign investors who are already in the country. It's a delicate balancing act.
Do you foresee any good results coming out of countries that are trying to go down this road?
In the past, when we have had what columnists have called currency wars, nobody has won. It ends up being a race to the bottom where, for competitive reason, one country lowers their currency and then another one does, and in the end, market share doesn't change, and they end up using up a lot of their foreign currency reserves. So the best way to play this game is not to start.
Thanks, Carl, very much.
Good to be with you.
Thank you for listening. For more insights from our economic research team, visit northerntrust.com/view.